Inflation concerns are drawing worry not only from Chinese bankers overnight, but in Europe, we're also hearing some concern as well. How affected is the U.S.? What does that mean for the global bond supermarket? We're joined now by Tony Crescenzi. He's Executive Vice President and Market Strategist for PIMCO. Welcome. It's good having you in person.
Thank you. Happy to be here.
And on the East Coast, give me a sense. Yesterday, we got some economic figures in the U.S. that made people a little bit surprised that inflation was maybe more of a concern than the Fed has acknowledged.
Well, the Fed is hinged to the core, so to speak. In fact, it's following core rates because typically headline inflation doesn't permeate to the core. There is no spillover. Central banks globally seem to be watching whether or not there will be spillover from headline inflation, which of course includes food and fuel, to core prices, which include tens of thousands of other items, literally. So with the Fed hinged to the core, that means it's more likely to keep rates low. In fact, not raise interest rates, even though headline inflation is picking up. And this steepens the yield curve because long-term investors, of course, will be more long-term mindful in the sense that they'll think about where inflation might be several years out. The Federal Reserve, of course, has to worry about that too, but in the near term, it's worried about its dual mandate, which, of course, is also to boost employment as well as keep inflation low. And so it's a recipe for a steeper yield curve to the extent that the Fed is hinged to the core, and we'd expect that to continue throughout 2011. The core meaning
they're stripping out the things that consumers would experience as causing a higher cost of living.
Most Americans would say, what about food and fuel? Can the Federal Reserve have any impact?
Right.
But remember, the Fed can have limited effect on those things because they're determined by the global marketplace. And the Fed, by printing money, people talk about, you see commercials about the Fed printing lots of money and it's creating inflation. It isn't creating the recipe for inflation. It has put a lot of money in the system, but what are banks doing with that money? I would say the Fed is equivalent to Yucca Mountain, a repository where nuclear waste is held.
How's that?
Well, in the sense that the Federal Reserve is putting money in the system that the banks put right back in the Fed. So, yes, reserves are toxic. They could cause inflation, but they can't cause it so long as it's in Yucca Mountain or held at the Federal Reserve because they're not dangerous. And when the money seeps out of the Federal Reserve, when banks begin to lend, then you've got a different story. Then banks can expand the money supply vastly because there's a huge multiplier effect of those reserves and what it can mean for money supply growth and hence the overall economy.
Well, we're watching in Washington this question of how hard and how fast a deadline March 4th is and the end of March because of the debt ceiling, basically the government's credit card running out. Are you seeing that impact the markets? It
has had a big impact on the money market. Many investors probably won't see this, and it won't sound like much when I say this. The repo rate. This is an overnight rate that it's a $2.5 trillion market, a big part of the money market. It's where investment firms like PIMCO and others will take cash and hand it over to a dealer in exchange for collateral, which is treasuries. And that interest rate was about 0.22% for a while, close to the Fed funds rate, the rate the Fed sets, about 0.25%. That's fallen recently to 0.15%. Doesn't seem like a lot. That has fallen 7 basis points, but it's a big deal. It's another example of how government involvement in markets, becoming more of a player in markets, is affecting market prices. And so investors like PIMCO have had to shift around this movement in the repo rate and T-bills. T-bill rates are falling. Last year when this happened, when the debt ceiling fight occurred over a year ago, T-bill rates fell to near zero because there's certain technical things that happen that cause T-bill supply to be reduced, and investors, therefore, the lower supply of anything increases its price. So it's affecting markets, the money market, a great deal. It's increasing the amounts of liquidity, but in terms of disruption to broader markets, not much because people expect the debt ceiling to be handled in the wee hours of the morning somewhere on C-SPAN when no one's watching.
I want to bring you in on this story. I mean, what's the take? You're a market participant. You're a strategist. You just say ignore the economists?
Sometimes. For example, the last couple of years, the market's been expecting the Fed to eventually reverse its zero interest rate policy and push rates higher again. And the market again is priced for the Fed to raise interest rates by December. In fact, by March of 2012, the bond market and we know this by Fed funds futures and Eurodollar contracts and other things, the market's priced for the Fed to have raised rates almost 75 basis points by that point. So a half-point hike roughly in the first quarter of next year. So the markets have been wrong repeatedly. And usually when the markets look about 4 to 5 quarters out is where they tend to be wrong, and you can judge this by performance of Eurodollar contracts. Eurodollar contracts are tied to the Fed funds rate, the rate the Fed controls, and so they'll move accordingly. And so the market, we think, again, at PIMCO will be wrong in terms of the timing of the first Fed rate hike. The market's continuously pushing that out. There always is this feeling the economy will get better, strong enough for the Fed to reverse its policies.
And it gets you to the escape velocity question. When can we get out of emergency, funding and support? But I want to ask you, how much is QE distorting things, and how much is, the global uncertainty, instability in the Middle East, once again creating buyers of treasuries, thus changing the thesis again and again?
Probably not as substantially, because interestingly, the dollar did not perform all that well during the upheaval in Egypt and its continued upheaval in the Middle East. And so there isn't tremendous movement into treasuries from it, but it is the deepest, most liquid market, so money will flow to treasuries in times of worry and anxiety.
Still? What, least dirty shirt? Isn't that the term?
You could call it that for a while longer. Remember that the U.S. has a printing press, and so it can probably avoid default in the long run.